Hello and welcome. I'm Jonathan Beale and this is the ASB Investment Podcast, a show that keeps you up to date on the market and helps you make smart choices with your investments. Chris Tennent-Brown is back in the booth with me today to give us the latest market update. We'll cover the recent official cash rate cuts and what happens when interest rates go below zero, as we've seen in Europe. We'll also chat about the inverted US yield curve. And speaking of the US, we have some updates from the front line of the trade war. These are entirely our own views. It's not investment advice, but we know plenty of experts at ASB that'll be happy to chat if you need. Chris, great to see you again. Welcome back to the booth here in just off Ponsonby Road.
Yeah, it's awesome to be here. Yeah. Thank you.
And everything well with you? What have you been up to in the last few weeks since we last spoke?
Oh, well, like many people, I've been struggling with this winter weather. It feels like it's been raining forever.
It has.
And being keen on flying, the only thing I've seen flying is ducks, and I haven't been up, which is frustrating, but it does mean my bank account's looking a little bit healthier than usual.
That's a positive.
That's
a positive. But, and I've been lucky enough. I've been away, so I think I said last time I turned the ripe old age of 50, so I treated myself to a holiday, so I've missed all the sort of wet and cold weather. I've been in the sun, which has been beautiful, but I did come back to a bit of a surprise. I got back home and the turntable I think I talked about before that I had for my birthday, when we came into the house, one of my kids noticed that the top of it was all sort of rough and cloudy on the lid of the turntable. And so we wiped it down to see what's there, but it didn't change. It was almost like it had been something had burnt into it. So I took it back to the shop where it had been bought and carried the lid in. And I showed it to the guy there, and he goes straight away, "Oh, have you got one of those sprays that kills flies in the room?" I said, "Yeah." He goes, "That's what it is."
Oh, jeepers,
and I'm
creepers.
Like, "Well, it's literally burnt. It's all rough and it's cloudy." As I said, "Goodness knows what's in that stuff that's coming out of it. They don't put that on the tin."
Kills flies and turntables. Well, I hope that was in the disclosure statement.
Exactly.
Given the boring ones we have to record for these podcasts, that's the vital sort of information you need to know.
Exactly. I'm going to complain vehemently to the fly spray people. But anyway, we're not here to talk about fly spray. We're here to talk about what's going on in markets, and there's a heck of a lot going on. So, but I'm conscious in a few of the podcasts before we've talked about interest rates, and I think we'll get there. But we don't want to be Groundhog Day of every podcast being about interest rates. So we thought we'd maybe take the conversation a little different places today, if we can. And I think one of the things that I've noticed in the press, certainly recently, is there's been a lot of talk about this inverted US yield curve, and it seems to be the most important thing that's happening globally. I'm not convinced everyone would actually understand what that means. So with your super brain, Chris, you're able to explain really simply, like, what is that? What is it? And what's the importance of that to maybe us and the way we invest our money and what's going on in the economies?
Yeah, I'm always amazed when some obscure thing that I learned at university suddenly becomes everyday discussion. And the inverted yield curve does pop up every now and then. Basically what we're talking about here is when long-term rates get a lot lower than short-term rates. Now that in itself doesn't cause anything to happen, but it does reflect how people might be feeling when they go to invest. Because at the end of the day, why would you invest for 5 years and only get 1% if you could invest for 1 year and get 2%? Well, the reason you do that is you're really worried about the future. Maybe you think that the economy is going into a recession and interest rates are going to absolutely plummet. So you want to lock in whatever you can. And that's where the inverted yield curve is used as actually a reasonable predictor of recessions in the States. Now, this sounds like, okay, this is the key thing we need to see and suddenly change what we're doing. But the problem is, technical indicators like this don't always work, and they're not particularly timely. On average, over the years, recessions come about 14 months after the US yield curve's inverted, but sometimes it's just a tiny slowdown. Sometimes it's a long way in the future. So it's about as useful as me saying to you, hey, well, we've just had the shortest day of the year, so I forecast the longest day is coming in about 6 months' time. What we really want to know is what the weather's going to be doing. And so this is telling us something we already know, that the US economy does look like it's going to be slowing down. It's been growing at a tremendous pace. Partly because of the stimulus Trump's been providing, partly because it's just had an amazingly strong run for over the last 8 years and now it's slowing, but it's not about to fall into a massive hole. And of course, the US Federal Reserve is now cutting interest rates, so that's another reason why those long-term rates are getting lower.
And there's a difference between a slowing economy and an economy in recession, though, isn't it?
Yeah, and recession from a technical perspective just means the economy contracts for 2 consecutive quarters. Now, if it contracted by 0.1% each quarter, that's a recession. What people get their thoughts muddled up on when they get really petrified from an investment perspective is a deep slowdown that really impacts share markets, like the global financial crisis. Most developed economies really contracted and share markets really plummeted. But if we look over the past 20 or 30 years, the reality is a recession comes along, not every year, of course, but every decade or so we should expect to have one as an economy cools. In New Zealand's case, they're often associated with the weather, or they can be things that we could never predict, offshore shocks like the Asian crisis. But anyway, that's what people are fixated with, is the US economy slowing. What does this mean for shares? Really what it means for investors is just global interest rates remain incredibly low. And in the US, they're on their way down, aided by the US Federal Reserve cutting rates for the first time in a number of years.
And we talked about the US yield curve. Is the same phenomenon happening here in New Zealand?
No, we've just got low rates. But if you look at a 10-year government bond yield here, it's higher than a 2-year government bond yield. And so that's a normal thing that you'd expect to see. If people are going to commit money for a longer period of time, you'd expect, and they'd expect to get a higher return for doing that. What we have got, though, is an incredibly flat curve. You don't get much reward for tucking your money away for longer here. And we can see that in the term deposit space as well. So that's the challenge here. But our interest rate curve is a bit more normal shaped than elsewhere.
So obviously, since we last spoke, the official cash rate was reduced, and you've been very consistent about you thought there'd be a cut. But were you surprised about the size of the cut this time? Yeah,
I was, and we get asked to assign probabilities for every meeting. Will they hike? Will they stay on hold? Will they cut? And we've been saying they'll cut for a long time, but I wouldn't have put a high probability on them cutting by 50 basis points. I'd think they want to get rates lower. But they want to keep their powder dry and have room to keep on cutting in the future. Whereas the Reserve Bank thought the economy needs lower rates, let's get them there now, and went for the 50 basis point cut, or 0.5%. So now our cash rate's down to 1%. So the risk with that is that you spook everyone a bit. Them thinking,
which seems to have happened.
Yeah, is it that bad? Do we really need to? This is seeming pretty drastic. But on the other hand, the Reserve Bank wants some bang for buck, and they've got that. We've seen some decent movements in the exchange rate. It's lower, which helps the economy. And we've seen interest rates within the economy drop as well across the board. Government bonds, wholesale rates, term deposit rates, mortgage rates. They've all come back, which ultimately is what the Reserve Bank wants to see when they're trying to create demand and then in turn inflation within the economy.
When I speak to customers, I think the 2 questions we're getting asked at the moment. The first question is, so what happens if it goes below 0? And is that possible? And the second question is very much around what impact is that going to actually have on us if that happens? So let's go. Let's take the first one. So do we think actually it's going to go below 0 and have negative interest rates?
Well, I have to admit I've learned to be more open-minded as the years have gone by, because I wouldn't have picked that rates would get this low if you'd asked me 10 years ago. And I thought these incredibly low interest rates were something that really weak economies like Europe or Japan had to endure. But you can't rule them out. Here's the thing which I find the most unusual is we've got the lowest interest rates we've ever had by some measures. Things like mortgages, you have to go back into the 60s to see them. We've never had the official cash rate this low, even in the global financial crisis. But our economy isn't in a recession. Our economy is still growing, a little bit slower than what it was at earlier years, but we're still growing at over 2%. Which is good on a global scale, yet we're here with these incredibly low interest rates that we think are necessary to push the economy along. So if the economy kept on slowing or we had some sort of shock, the Reserve Bank has explored and is open to pushing rates even lower. And as we've seen in Japan and in Europe, they can go negative. I don't think they will, but we do think the Reserve Bank could cut them even lower than today's level over the rest of the year.
And so you don't think it's going to happen? It might happen, but if it did happen, what would actually be the ramifications for New Zealand?
Well, it's really weird. It's hard to understand the idea of negative interest rates, but what it means is simply this: if you invest, say you buy a government bond and you pay $10,000 for it, and it's a 10-year government bond. In 10 years' time, you won't get $10,000 back. You'll get less. Now, why anyone would do that is a good question. And places like Japan, where they've had negative interest rates or zero interest rates for a number of years, people have very high cash holdings. And why not? If you're going to lose money by giving it to an institution, maybe you should just hold on to it and buy a good safe. So what it tends to mean is that there's just a worse return or a loss on extremely conservative risk-free investments, if you like government bonds, and very, very low returns on everything else. So it's really tough on savers, particularly conservative savers within an economy.
And we were talking earlier about Denmark, and Denmark has negative mortgage rates. So people are actually the banks are actually losing money on that, and customers that actually don't have to pay any interest at all. That's like a bizarre scenario, isn't it?
Oh, this is nuts, and it's really hard to get your head around. So the thing which can happen here is the bank will obviously have to get its revenue from elsewhere, but if you got a 10-year mortgage, there's a bank in Denmark that will reduce your loan by 0.5% per annum. And even things like 30-year mortgage rates are in the low single digits. It's just bizarre. Now I'm sure they recoup some of that through fees, but what it means is that there's very little incentive for people in Denmark to pay off debt. And this provides another reason not to pay it off, because it'll slowly chip away at itself. And as a consequence, Denmark's got extremely high private debt levels. Now, the bit there, though, there's a little bit more information to that, is that they do have very high savings in other things. So the equivalent in New Zealand, if we got to that scenario, is I think people wouldn't have very little interest in paying off their house, but they'd need to put more money into their retirement savings if they were to do that.
So it seems like very real that these things potentially could happen. They're happening around the world. I don't think New Zealand can sort of go, well, it won't happen to us, where it's still a long way off, but it does happen, and people are living with this every day of the week, aren't they?
Yeah, it's just this low interest rate theme that we've talked about so long that's been a backdrop for 40 years is reaching an interesting end game in some economies as they get towards zero. And I would have never, ever thought that you'd structure a mortgage with a negative interest rate on it. And as I mentioned, there'll be fees and things in there, but it's just remarkable. And the net consequence, people carry an awful lot of debt if they don't have to pay for it. Debt's just like anything. When it gets cheaper, we want more of it. And that's what's happening.
And then so we're seeing that we're reducing interest rates. They're trying to stimulate the growth of New Zealand. But business confidence still seems to be low. So there just seems to be, you're almost getting to the point where the Reserve Bank are going to run out of things they can do. The lever, they're pulling it pretty hard, and they haven't got much more scope to do it. How else could they increase business confidence? What sort of things could we be doing?
Well, at the end of the day, you have to go, well, if businesses don't want to borrow at these levels, will it make much difference if rates get much lower? And that's telling you about confidence in the outlook and demand within the economy. I think the important thing to remember here when we're looking for solutions is New Zealand's not alone in this. There's a lot of uncertainty around the world, and a lot of economies are in a similar place to us where they're just growing a bit below potential. And we actually stack up pretty well on a global scale. When you start to get this sort of level, though, I think it's right to think, what else can we do? And one of the things that I hope gets discussed a lot is, well, the government's in a strong position. They're running a surplus. Debt levels are really, really low. Should the government be doing the heavy lifting rather than just trying to push lower interest rates into the economy to stimulate demand? Because, of course, that's good if you want to borrow, but it's really tough if you're a saver within an economy, particularly a conservative saver. So we're seeing the same in Australia with a lot of commentators or economists such as myself saying, hey, is now the time for some appropriate fiscal action or government action? Now, some people would say that should be infrastructure spending. Other people would say it should be tax cuts. But it is an alternative when you want an economy to go better, is to look at what are the fiscal things that could be done.
It just feels as though like we're getting to that point where something has got to change, though, isn't it? Like all around the world, we're just pulling interest rate levers, and it doesn't seem to be making too much of a difference. And if you think about mortgage rates, when the cut happened, they didn't reduce by that much.
Yeah, the floating rate was the only one that actually dropped by the 50 basis points or 0.5%. The other rates went down by smaller amounts, and actually it's flowed out over the course of a week or so. At the end of the day, we don't fund at the official cash rate. A mortgage is made up of our term deposits, wholesale money, and those rates are what also determine what a mortgage rate will be. So we've seen them come down a little bit over the subsequent week or so, but they're not as down by for the fixed terms or term deposits by the full amount of the cut, and that's the way it's been working for a little while now. And one of the things which people think about when we're talking about rate cuts is always on the mortgage side of things, but term deposit investors, we still need to pay a rate to attract them and make them want to keep saving their money, and particularly for longer term. So that's a big part of it as well. And we've spent a lot of time in my team over the past week just working out, okay, is there a point where the wheels just start spinning in the sand? Rates can't go any lower, and that's when we don't know whether we're there yet. Term deposit rates have got lower in other parts of the world, but there is that really important trade-off, and I think we have to really think about the people on the saving side of the equation as well, because it's really tough when we're down into the 2.7% or so now for a longer term deposit.
Yeah, I'm glad you raised that, because there's a bit of a worry I've got that with people with term deposits, low interest rates, maybe they're living off the term deposits, helping fund their retirement or whatever, or their lifestyle or what they want to do. And actually, with low rates, you're not going to be able to do what you used to be able to do. And you've got a couple of options. You spend less, but why would I want to do that? So people start looking for alternatives, and I think that worries me, because people start making decisions based on, well, what's the return going to be, and we had that. You only go back to sort of finance companies years ago, which was very driven by what the rate was. So I'm worried that people will make the decisions to go, hey, well, I need a higher rate, let's invest in this, but not really understanding maybe the risk they're taking. And we can see that. I can see that playing out already in some of the sort of presses and the advertising you see in the papers at the weekend.
Yeah, I think that a really important thing to remember is just because interest rates change, your risk profile doesn't. If you're a conservative investor, don't start taking a whole heap of risk to generate a return, particularly if you're not clear on what it is that you're doing. And that was the problem with some of the finance companies, 10, 15 years ago. So it just makes it more important than ever to have a really good plan and think really hard about what the money's therefore, what it needs to do, and when do you need it? Because some of the things that we talk about a lot, portfolio investments with exposure to all sorts of assets will generate higher returns than term deposits. But the time frame is incredibly important to make sure you get the benefit of those diversification in the assets that we hold. You can't just leap out of one thing completely into something different just because interest rates are falling.
Exactly. And if you think about what's going on, look at the quarter that's just gone, and the performance has been outstanding. Like, I think if you're in the growth fund, you're getting sort of 7% over the last quarter. Even a conservative portfolio is returning sort of 2.25%. Like, ridiculous amount of growth for what you'd normally expect. What's driving that, do you think, Chris?
Well, this is the interesting thing within a portfolio is the bonds are actually one of the strongest drivers of performance. Bonds have performed better than shares if we're talking about global bonds and global shares at times, which doesn't make too much sense. But the bonds that we've held for several years, which pay much higher interest rates, are worth a whole lot more as interest rates fall. And so that has really boosted portfolios, along with shares. I mean, the share markets have been really volatile over the last week or two with Trump's latest antics. But the New Zealand share market's only a couple of percent off its all-time high. And the US share market's down about 6% from its peak. And but on the whole, they're still both up a lot over the last 2 or 3 years, so that's boosted portfolio returns as well. So that probably won't pan out exactly like that each quarter, and that's where this time frame comes in and so important. It was only in December that we were looking at all portfolio returns were really tough, and a lot of the funds were negative over the quarter, and then they came roaring back with the strong share market performance and this rally lower in interest rates we're seeing through the course of the year. But that's why we keep on talking about the long term, because we do have tough months, we have tough quarters. But the recent times, the drivers have all aligned right up until the last couple of weeks when our main friend in the US started tweeting and stirring things up.
You're not saying his name anymore, or?
Yeah, no. Trump's has certainly been creating a bit of volatility. It's not just him that's been upsetting markets. There's the situation in Hong Kong has rattled investors as well, and we can see that in some asset classes like global property. The property in Asia was an underperformer over recent times, partly because of the protests we're seeing there. But Trump is in the thick of it as he has been a lot over the last couple of years.
I think you made a really valid point, because you're talking about US share markets, headline US share markets down 3%, worst day for a long time. But the context is important, isn't it? About where it's coming off a record high. If you look over the performance over the last 2 to 3 years, it's been stellar. So maybe it's that whole sort of like, well, let's just tell the true story, a bit like Trump. Let's tell the true story of actually what's going on, so people can make informed decisions and understand what's actually going on.
Yeah, and it pains me to say it, but realistically, we're only a tweet away from having a great day on the US share market, it seems, these days. But that's no way to save for your retirement, waiting to see if it's a good tweet or a bad tweet day. You've just got to be able to look through this stuff, which is difficult at times. But really, the past couple of weeks' performance has been a lot of stuff that we've experienced over the last 18 months or so. And the thing which is getting really different from a New Zealander's perspective is these record lows that we're seeing in interest rates, because they do have a direct impact on people, and we can get a lot of information, quite predictable information, on what the outlook is, be it the RBNZ governor's words on what the plans are for interest rates.
I was telling you earlier that we had investment committee yesterday, and the chairman of the investment committee is Gavin Walker, who just happens to be the chairman of the bank as well, and he said something. I actually wrote it down. He talked about, if you think about what's going on, we're seeing sort of some volatility coming back into the share market. We've got interest rates at all-time low. You've got inverted yield curves and all these things, and people are sort of getting a bit, obviously getting a bit worried. But he talked about how what he's so pleased about is about the way ASB manage money is that we've got these anchors in place, and we're confident about our anchors, and we're able then to ensure that we're disciplined about how we manage money. And I thought, wow, you've summed that up beautifully, because it's times like this where people do make rash decisions. People who are investing money make rash decisions. Some people who are managing money will say, we need to do something different. It's actually coming back to, what do you believe in? What's your asset allocations? Why have you made those decisions? Keep reviewing them, not saying we need to do something different right now. And if you think about the analogy, if you're in a stressful situation, you want calm people around you going, okay, let's just break this down. What can we do? And I think that's a good message to get to people, isn't it?
Oh, totally. And I think that discipline with how we as a group manage money extends to how we advise people as well, because interest rates are low and a term deposit isn't generating the return you want doesn't mean that you're suddenly a high-risk investor and you should completely change your strategy. It's a time for executing long-term, well-thought-out investment strategies, both as a saver getting advice and an investment manager like ASB managing money.
Yeah, I've been in financial services a long time, but it is almost the boring things that actually get people through. So it is having a plan, diversifying, medium to long-term view on it, understand what you're in and why is it going up and down. It's always going to go up and down. That's what markets do. But over the medium long term, hopefully you're going to get a better outcome than if you've done something different. And those basics and these types of moments in time are more and more important, I think.
Oh, yeah, and I think my job can be boiled down pretty simply is to help people focus on the long term and look through some of the noise and information we get that's often very short term. This week's one being the inverted yield curve and the latest tweet from Donald Trump.
Exactly. Hey, let's just maybe finish on some of the things I know is very topical about the trade war and how what's going on and how's that impacting. Do you want to just give a bit of an update on where you think it's at and where it potentially might go?
Yeah, I think from a political perspective for Trump now, this is getting to the point where perhaps his voter base is realising that trade wars aren't easy to win and they're not good because we're starting to see some real negative impacts from them. Early days when they're putting tariffs on China, they were smaller on a narrow range of goods. Now that he's got the big bazooka out and proposing tariffs galore on pretty much everything, that will flow through to the shops, and people will see it. And these global growth concerns that have been troubling share markets, it's not just investment experts that are connecting them to Trump. A lot of people are. So it's starting to sound a little bit negative for a lot of people. And we're in we're a year out from the election in the States soon, and so he's going to want to get some wins. So his latest thing is a couple of weeks ago, we're going to increase the tariffs. The tough man talk. And now he's pushed it out a few months. And I think part of it is at a really simple level that they would have been putting tariffs on things that would have been appearing on shelves that people would have been buying at Christmas time. And it's pretty basic stuff. But the deeper part of it is these are really complex, and Trump's way of dealing with things doesn't seem to be working. This is a long drawn out process now with China, and it doesn't seem to be working particularly well from at the moment. But as I mentioned, the painful thing is that we're perhaps only a tweet and announcement away from it being great again, and for us we just watch and. What's a polite way of saying it? We live in interesting times.
We do. I was amazed. I was in New York when I was on holiday and caught up with some old friends I hadn't seen for a long time. It was awesome. But as soon as I mentioned the word Trump, the whole atmosphere in the restaurant changed around our table. Like you could see how embarrassed and upset and angry they were about actually how the country has got themselves into this situation. And I sort of asked, how do you think it happened? And they just got no answer. And it was really, like living in New Zealand, actually, proud to be living in New Zealand and being a New Zealander. But in America, the people I was talking to were just like, this is astonishing. I just don't know how this happened, and we're embarrassed by the whole thing.
Yeah, and the other side of it is there's people that are running small businesses that have got a tax cut and thinking, hey, that was a really good policy for us. And it's really interesting. I think New Zealanders are really focused on what's going on in the world, and we're really, really aware of it. And so we get really impacted by this. I think that's part of the low level of confidence we're seeing in New Zealand is we've got so much information on these global things. But Americans' focus is a little bit more internal. For a start, they don't need to trade as much with the rest of the world as we do. And so some of the things will be reflecting on, how does this policy impact me? Whereas we tend to think, how do these policies impact the globe? And we're a trading nation, so we tend to pick up on them because we think they could impact us. So Americans have all sorts of sentiment about it. And it still wouldn't surprise me if Trump got a second term. I'd preferred that didn't happen. It would give me something different to write about and us to talk about. But that could be the case, and that's, I think, going to become increasingly important over the next year to start getting some wins. It's pretty hard to get re-elected if the share market's really suffering, and pretty hard if you don't have runs on the board with things like your trade negotiations.
Great. Well, really good points to finish on. Thank you, Chris. I think you've added to my T-shirt idea collection. So I've got lower for longer. Now I've also got one tweet away from the share market going up. So the collection's getting a little bit bigger. As always, thanks very much for your time. I think you've really articulated some of the issues at hand and explained them really clearly. So look forward to talking to you again. Thanks a lot.
Good stuff. Thank you.
Cheers. Thanks for joining us today on the ASB Investment Podcast. If you have any thoughts on today's episode, or if there's anything you'd like us to discuss on future shows, please fire your suggestions through to podcasts@asb.co.nz.